Do you know?
Yeah, webinar attendees, thanks for joining. We appreciate your time. And we have wonderful speaker as you see the video. If you cannot see the video, please type in and out any question. But again, this is, as you see the slide, share screen on my screen, see the content, the speaker session, one by one. We're gonna zoom momentarily. But as I said, feel free to type it out, any question, about the topic, about the webinar. So the first part is opening remark by Susie Kang. Okay, let me admit it. Somebody's waiting. Sorry, just give me 1 second.
Yeah, there are 3 people waiting, 4 people waiting.
So Susie, if I miss it, you can admit it all. Let me see. Okay, good.
Oh, I can do that?
Yeah, good.
Okay.
So now is opening remark by Susie Kang, founder of Austin KREA. Susie, would you please open up and welcome everybody here?
Welcome everybody who joins our webinar this morning. I'm Susie Kang, founder of Austin Korean Real Estate Association. This is our second webinar, and today we will have an expert from their fields, David Tucker, who's a CPA, Will Jackson from mortgage, Jack Szalasny from fix and flip in real estate investment, and Chris An from Joa Realty. I want to welcome to everybody who joined from Korea, the nation as well, and then hope that you will get one thing to learn today and use that for your investment or your future investment in real estate. We are in the most challenging pandemic era. However, some people say crisis is an opportunity, and this is why we are offering webinars so that you can get some opportunity from this challenging era. You may use a chat room on the bottom to write the questions, and we will have a Q&A sessions in the end and hold your questions, and then we will answer all your questions based on those experts. Here's Chris An, who will be our MC this webinar. Chris, please.
Yes, Susie, appreciate your introduction. Wonderful. And so the first speaker, the topic is tax reporting for part-year short-term rental, Airbnb and VRBO by David Tucker, CPA. So David, could you please introduce yourself a little bit and start your presentation whenever you're ready?
Yes, sir. So my name's Dave Tucker. I have a small tax practice in North Austin. We have 10 individuals that work for the firm. We've been in business now for over 20 years and service individuals from LLCs, corporations, as well as individuals. We do payroll processing. We do corporation formation, and also we have a department that handles bookkeeping. So it's been a challenging year, as I know it is for most of the companies out there and individuals. The one item I want to get into today deals with short-term rentals. And up until COVID, this was a pretty hot market. We had individuals that were buying facilities to VRBO them. We have individuals that would rent out a portion of their house, even as a home guest, if you will, or renting a room out. We had other individuals that during South by Southwest might move out of their homes for 2 weeks and rent those out on a vacation rental or Airbnb type of arrangement. The tax ramifications with that, and that's specifically the short part of my topic right now, is that it still needs to be reported. So any rental income, even if it was just a household roommate or a VRBO, would be reported, and the specific form, and I'm assuming it's either a single member LLC or a 1040, would show up on what we call the Schedule E. And Schedule E is where you would put your residential rentals, or in this case, your short-term rentals. So the income should be reported, and then the typical expenses would be able to be deducted, and that would include the VRBO or Airbnb fees. If there was a hotel occupancy tax, that's deductible. We get into certain other items, though, that we have to think about, and that's where this flow chart comes into place. If you use the facility for personal reasons for more than either 14 days or 10% of the rental days. So we refer to rental days if the Airbnb was rented out for 200 nights. Basically 10% of 200 nights would be 20 days. If you have more than 20 days that you personally use that facility, it's called a mixed use property. And there are some unique items with a mixed use property. Some of those aspects being you have to allocate the mortgage interest, if there is a mortgage, as well as property taxes between what was business, again, that flows to the Schedule E, and what would normally flow as an itemized deduction on what we call a Schedule A. So one needs to allocate that. Same thing goes with depreciation. Many individuals own property that they lease out full-time to a third party, and those types of expenses, there's a depreciation coefficient. And for a residential rental, buildings are depreciated over 27 and a half years. So if it was a full-time rental, you would be able to deduct the full amount, which is a little less than 4%, as depreciation. But if it is a mixed use, and again, that's where we get into this particular subject matter, you would have to allocate only a percentage as a depreciation expense. So there's many types of expenses that could be allocated to a residential rental or a VRBO, let alone the mortgage interest, depreciation, property taxes. There could be HOA or homeowners association fees, the utilities. So again, if you have utility bills of $300 a month, and that would include things like telephone, internet, electric, and gas, you would have to allocate those expenses between what was used from a business standpoint, what was rented, the number of days, and what was a personal. And of course, you can't deduct utility bills that relate to the personal portion of it. And then there's some other expenses, and I think this is a good time to move to the next slide. There are certain expenses such as you had to stage the property, okay? So you had to buy $5,000 worth of bed sheets and towels, and those items can amount to some money. I've seen some people spend $5,000, $6,000 on those type of items. I wouldn't necessarily write them off in the first year that you buy the items. I might allocate those expenses over 2 years. So those are some of the bigger items, but as we look at this particular schedule, it basically shows that the rental income always is reported on what we call a Schedule E. And the difference on this particular slide between the mixed use, and again, in the first category, it does show that if you rent it out if you use it more than 14 days personally or more than 10% of the days the unit was rented, you have to split those expenses between personal use and business use. The other aspects being on a mixed use property, you cannot report a loss. So if it's not rented out 100% and you don't qualify for the definition for what's a personal use, you can't show a loss on that property, but the losses are carried to the next year. Whereas on a full-time rental, you are able to deduct the losses subject to limitations. For those real estate professionals out there, you're allowed to deduct all of the rental losses. But for other individuals, such as myself, and I rent out 2 locations, I'm not a real estate professional. And because my AGI is over, my adjusted gross income is over $150,000, they say I can't deduct any of my losses, and I can only deduct those losses when I sell the property. It's called a passive activity loss carry forward. So there's some unique tricks in here. Again, hopefully after the COVID season, we're going to see more activity in this marketplace. The last slide, please. We actually assist at least 125 realtors, both agents and brokers, with their tax returns. Many of these are in LLCs or S Corps, and they can save some significant money as being an S Corp. We're open year-round. I welcome any questions. You can email that to the info@dtuckercpa. We also have some great worksheets on our website under Client Service Center that give you examples of how a vacation rental or Airbnb would be broken down. So at this time, I'll turn it back to our meeting host.
Thank you, David. Again, attendees, please feel free to type it out your questions during the session. We are trying to accommodate, answer all the questions. If not, we're gonna answer our Q&A session end of the session. I mean, the end of the webinar. We're gonna have approximately 5 minutes. And then, yeah, thank you again. So the second session, the lender session, a current guideline under COVID-19 and how it would affect you, by Will Jackson. So Will, could you please introduce yourself a little bit and start your presentation whenever you're ready?
Yep, if you could maybe give me the second slide.
Second slide.
So I grew up in the Austin area and went to high school here, graduated from the University of Texas. I started my mortgage career in June of 1998 when I graduated from UT, and then moved to Dallas for a little while, then to LA, then to Denver, then I came back to Austin, and then I did a short tour in Houston. But I've done 22 years of mortgage in Texas, and all but about 3 of those have been here in the Austin market specifically. I live in the Austin area with 2 of my 3 kids. My oldest is off at college in Boston. So that's kind of a little snapshot of me personally. And then I guess if you change to the next slide and we can kind of dive into the actual content. Basically, you know, kind of the subject matter here is mortgage or the mortgage environment with COVID going on. And so really the biggest story right now relates to interest rates. Interest rates are at an all-time low. I saw this morning that the Fed is pledging to keep interest rates near 0 through 2023 to help with, you know, the economic recovery from the pandemic. And as a result of that, I expect that interest rates will stay, if not quite as low as they are now, still very low and attractive for the next several years. The benefit of that is it makes purchases more affordable, so you can qualify for, you know, more house and have a lower payment. Refinances are also attractive, whether that's just to, you know, shorten your term or reduce your interest rate, or if it's to take cash out, maybe for a down payment to buy another property or to fix up a property to sell, to upgrade or something like that. So, you know, there's definitely a lot of benefits to the low interest rates we're having right now. Forbearance is something that's come up a lot over the last 6 months, and what that refers to is when lenders stop requiring mortgage payments during the pandemic. The government came out and said that lenders cannot report people late if they're in forbearance. So fair number of people have actually taken advantage of this, and different servicers have been handling how the repayment of those missed payments are handled. Some are tacking them onto the end of the loan, some are spreading them out, etc. The thing though that you need to know with the mortgage environment right now is if you do have a loan that you've put into forbearance, your credit will not be adversely impacted by that. However, you have to be back out of forbearance and making payments to get another mortgage. So that is something that you would have to be aware of. You couldn't be in forbearance on one loan and then get another loan without taking it out of forbearance and starting to make payments again. Self-employed guidelines, self-employed individuals have been scrutinized a little bit more strictly through the pandemic, and that's because these business owners are often affected by the pandemic. And so the big change is it's pretty normal, for a self-employed borrower to get 2 years of tax returns, and then for the current year, a P&L and balance statement. That's normal mortgage guidelines. What has changed during the pandemic is most lenders, including the big backers like Fannie Mae and Freddie Mac, are requiring in some instances that we actually collect receipts or bank statements or invoices or things like that to demonstrate that a business is still receiving the revenue that they say that they are, because the balance statement and P&L are not required to be audited by a CPA. So sorry about that, David. And then, when we look at W-2 borrowers, which is a traditional employed individual, let's say you work as an engineer for Samsung or something like that, really the only big differences there are related to, we're going to be doing a verbal, meaning calling up to make sure that you still work there and haven't been furloughed or laid off within a couple of days of closing. And that, there was typically a 10-day call before the pandemic hit, but since then there's been an even shorter one right before closing that Fannie Mae and Freddie Mac are requiring lenders to make. So we're having to do that. Another change, which is not a huge change, but it's in most cases minor, is we've seen Fannie Mae and Freddie Mac roll back a little bit on the debt to income ratio and reserve requirements for borrowers. And what that relates to is, for example, your debt to income ratio is your proposed mortgage payment, any mortgages you're keeping, plus monthly installment debt, and revolving monthly debt. And that's divided by your gross income. That ratio typically was about 50% that you could go up to prior, and now it's been reduced to where a lot of times we can't get an approval with it being more than 45%. So there's been about a 5% haircut. And then reserves haven't changed too much for Fannie Mae loans, which are loans that are $510,400 or less. For jumbo, we have seen significant pullback on reserve requirements, meaning that whereas in the past you might have needed 3 or 6 months of reserves for a jumbo loan, now depending on how much of a down payment is made, we're seeing anywhere from 6 to 12 to 18 to even 24 months in cases where a lower down payment is made on jumbo. So that's kind of been, some changes in the reserve requirements. I didn't list credit as one of the bullets here, and I apologize for that. I probably should have. Going into the pandemic, it was pretty standard that for regular Fannie Mae loans, like conforming loans, you needed a 620 credit score. For government loans, so like FHA, VA, USDA, that kind of stuff, you needed a 580. Right when the pandemic started, those numbers changed and most lenders went to about 640 for most situations, but that's loosened back up, and most lenders, including us, are back to 620 for conforming loans and 580 for FHA and VA. Now, jumbo requirements are still a bit higher. Typically, you're going to need a 680 or higher to do a jumbo loan. There may be some other options where we can go down to 620 with a little bit more of a creative financing option. Down payments are not radically changed from before. So depending on income level or veteran status, you can still get 0 down payment for, if you fit within certain income guidelines, or if a property is within a certain census tract where they're trying to get, people to buy. And then just the standard conventional loan is still 3 or 5% down. FHA is still 3.5% down if you're not doing a down payment assistance program. Second homes, typically you're gonna need to put 10% down on. And then for investment property, and I know David talked a fair amount about investment property right before I spoke. The minimum down payment is generally gonna be 15% for investment property. However, most buyers choose to put 20 to 25% down. And the reason for that is if you don't put 20% down, you're going to have mortgage insurance and the rates are going to be higher. So once you put 20% down, there's no mortgage insurance. Once you put 25% down, there's no mortgage insurance and the rates tend to be more competitive. So that is attractive from a cash flow perspective on investment properties, whether it's a long-term investment property or a short-term rental like David was talking about. Another thing that's been impacted by the change in rates due to the crisis is turn times. Most lenders are seeing record volumes because of the low interest rates, and that has resulted in extended turn times for most lenders. It does vary depending on lender. I hear about some banks that are between 90 and 100 days to close a refinance, and then usually about 45 days to close a purchase. Other lenders like myself, I work for Movement Mortgage. We're a large independent lender with nationwide coverage. We can close a purchase in 30 days, and refinances are about 45 to 60 days. Appraisals, we do see extended turn times on appraisals. Whereas before a week was normal to get an appraisal back, now we're seeing 2 to 3 weeks, and often borrowers are paying rush fees to get them done more quickly. If it's just a standard primary residence or second home with 20% down or more, in the Austin market, we are seeing quite a few property inspection waivers, which means that you don't have to get an appraisal. And when we see that, we kind of do a little happy dance because then we don't have to mess with that. And then I guess, Chris, will you go to the next slide? And I see that question about home equity lines of credit, and we can circle back to that after I get through here. Then this slide is referring to non-traditional, I guess my slide cut off, so the AL dropped down. I apologize for that. There are some programs that are outside of the normal Fannie Freddie requirements, and they're called non-QM or non-qualified mortgages. It's alternative mortgage programs. So during the early stages of the COVID crisis, all these programs went away, but they've come back, and the guidelines aren't quite as relaxed as they were before COVID, but they are loosening back up significantly. So for example, bank statement loans, I have 4 of those approved right now with buyers shopping for properties. And what that is using 12 or 24 months of bank statements to validate income instead of tax returns. The borrower does have to be self-employed for at least 2 years to use this type of a program. And so we can use a portion of the bank statement revenue or deposits as income. And that comes in pretty handy. 1099 for folks that are self-employed, but they work, as a contractor for a company for a couple of years and get paid 1099. We can use that in kind of like W-2s. So technically they're self-employed, but not actually self-employed. And those 2 programs are going to require a minimum of 15% down, but the rates do get better the more you put down. So just to be aware of that. And then the no income verified investment property program, basically the qualifying instead of income is based off a credit down payment and cash flow. And so, you know, David spoke earlier about short-term rentals. These are more limited to long-term rentals. And what we'll do is we'll look at the cash flow on the property. So if the monthly rents cover 110% of the mortgage payment, then we use that instead of income to qualify, along with a down payment of at least 20% and good credit. So that's kind of a nice option for folks that write a lot off of their taxes and want to buy investment property. They have good credit, they have good income, or sorry, not good income, they have good credit and they have a good down payment. Then they don't need to show any income to qualify for those programs. And then fix and flip financing. I know Jack is going to speak about fix and flip from an investor standpoint. From a financing standpoint, typically you're going to have to put down somewhere between 10 and 20% of the anticipated value of the property. So you're going to be looking at what's called an ARV, which is the after repaired value. So you buy a distressed property. There's typically somewhere between a 9 and 18-month bridge loan, and that's used to fund the repairs, and then you turn around and sell it. There are also fix and hold programs available. So, you know, if anybody has specific questions about those type of products, you know, I'm happy to come back to those. I did see a question about home equity lines of credit. Traditional lenders, such as myself, that are non-bank lenders are not really equipped to do a lot of home equity lines of credit. We can broker those out to credit unions and things like that sometimes. Some of the banks are doing home equity lines of credit. Some of them have stopped. For example, Chase Bank, you know, they stopped doing home equity lines of credit during the pandemic, and I'm actually not 100% sure whether they started doing those again yet or not. But with home equity, whether it's cash out on a first lien or a home equity line of credit, in Texas, it is limited to 20% equity position. So, you know, if you own a property that's worth $500,000, your max loan could go up to $400,000 on a first lien cash out. Or if you're doing a second lien home equity line of credit, you'd be capped at the two loans together, capping out at, say, $400,000 on a 500 valued property. And with that, here's my contact information. My mobile number and email address are probably the best ways to get hold of me. I often get questions about why I have a 737 area code if I've lived in Austin almost all my life. And I won't bore you with that story, but I had to get a new phone in a rush, and that's how I ended up with it. So if you have any questions, feel free to reach out to me. I think we have a Q&A session afterwards, and I look forward to speaking with you, and I appreciate your time. Thank you.
Thank you, Will. Yeah, once again, if any question, drop it out, type it out here, and then we will answer during the each speaker. If not possible, then we can accommodate it end of the webinar Q&A session. So that's my message. And the next third, the session that will be fix and flip on the coronavirus era by Jack. Jack, would you please introduce yourself a little bit and then start your presentation whenever you're ready?
Okay, well, good afternoon or morning, depending where you are. I'm Jack Szalasny. I've been fixing and flipping houses for about a little bit over 15 years now. I've had my ups and downs, but they're mostly ups. Of course, we've never had anything like besides the recession in 2008, this pandemic has probably been the most harmful to the fix and flip typical process that you go through and everything. So I'm going to touch on that, but I'm also going to go through just the traditional stuff we do in a fix and flip. I'm a retired real estate agent, but I'm not an accountant, attorney, tax advisor, realtor now, or financial advisor, anything like this and everything. Unfortunately, we've got a good group of people here who cover all those things for us. So starting out right on property renovations in general, this is not just COVID, but in general, the big things that you want to look out for is expensive things that are going to just kill your deal or kill your profit, I should say. So you want to look at all the major structural mechanical issues, roofs, HVAC, things of that nature, everything. They get that up very, very quickly. But you got to just count that into when you buy it. And the big thing that we say in fix and flip is you make your money when you buy your property, not when you sell it. And so you want to get it at the lowest possible price and the easiest possible fix, I guess, probably the ideal, which is kind of hard to find. I like to go towards high-end improvements that are low cost. Tankless hot water heaters are not cheap, but they're in the vogue. They're very energy efficient. They take up a whole lot less space than you would have for a hot water heater. So I aim for things like that. I can't remember who it was, but one of the famous motivator guys said, you sell the sizzle, not the steak. So whenever you do a property, you want to highlight features in a property. A $500 chandelier in the dining room will embellish the whole house, as opposed to just putting up $100 light fixture, something like that, and everything. So I'm a scavenger. I look for discounts all over at Lowe's, Home Depot, places like that. And there's a lot of times I just get stuff that's like literally 20 cents on the dollar. And if I don't need it right now, I'll buy it and store it in my garage. My wife doesn't like that, but we get over that. And when you do renovations, you want to look through the buyer's eyes. You want to, what's going to appeal to a buyer. And people, no matter, even when we buy investment properties, but especially when a person's buying their home, they key on emotions. It's just like what differentiates your property from others. So you want to really just make that property stand out. Things I gear in on our kitchens and bathrooms primarily, especially master baths. I renovate almost every one of I tell people I haven't taken a bath in probably 15 years or so. They look at me, it's like I've taken showers. I take most bathtubs out completely and just make a full-size shower. It costs about $4,000 to $5,000, but that updates that bathroom to like a brand new home. And you do get value in those type things. And kitchens especially. Garages for about $1,000 more, I can paint and epoxy floor a garage. When you go into a 25-year-old home, and most of those garages have stains, the walls aren't painted. $1,000 is not a lot of money in the grand scheme of things, and that just, the rest of the house looks great. You go in the garage, it looks kind of like dull, If I got a 1980s or earlier home, unless it's just an extremely old home, like stuff I got in San Antonio in the 20s, I replaced all the old toggle switches with those push button switches. Typically, I'll replace the outlets also because we got the old-fashioned outlets, and I'll put a couple of the outlets that have your USB cables connections in it, just to kind of, embellish the house. And you're gonna be different than the three other houses we looked at are very similar, probably in the same neighborhood. So you want to do those type things. And I stage almost every one of my properties unless I have it sold before we're done. Sometimes we'll have people literally walk into a property and say, "Oh, I like this. Are you selling it?" Well, not yet. We're not finished with it. And 1 out of 10, 1 out of 15, we do sell a house like that. So that you don't have to even stage it. And sometimes if I get somebody to write a contract on a house that I'm working on, I will, modify things to their, to how they want it. They want, different color paint scheme or something like that. It doesn't cost them, I'll do that. But typically I will stage a house. It costs $1,500 to $2,500 typically, unless you're in a very much larger home. And typically what a stager does is you rent your furniture from them. They put it in there. They hang pictures. A lot of times they put up a fake TV or a non-working TV, but the house will look like it's lived in, and it makes totally different from night and day. And at the end of this slide, I just got a couple of pictures of some staging I've done and some bathrooms I've done, just to kind of give you an idea. These houses sell on the wow factor. That's what makes it happen. Now on to COVID-19. The big challenges and everything. Probably the biggest challenge I found has been the time factor. COVID has really, really extended the time frame we have a house, and time is probably your biggest money breaker in a deal, as long as you got a good deal going. So finding a property hasn't changed much. Finding a contractor hasn't changed much. But as I say, finding a good contractor is always an issue. One of my last 3 ones I had issues with who we thought was a good contractor. We did not do our due diligence in following up with previous people, and had we done that, we probably would not have hired this contractor. So I'm as guilty as everybody else in not doing everything by the book. City permits have been typically a downfall in Austin and San Antonio, and now in San Antonio, it's been a major issue with 2 properties I'm dealing, but that is just something we got to deal with. I've had a little bit of actual material problems for some specialty materials during COVID-19. Surprisingly, listing and showing properties has been a lot of virtual showings. People write a contract subject to them going to look at the property. All the properties I sell are vacant, so it's not a matter of people not wanting to go into their property because there's people living it and everything. That's been helpful for us. And as well referred to also, there have been some issues with appraisals taking a little bit longer and the actual loan process taking a little bit longer. That's just, again, that's just part of the COVID-19 challenge we're facing. But other than that, it's just selling your property and closing it. It's been very minor difference. So the big thing has been permits, the city's doing it, and just a little bit of contractor delay and material delay. But other than that, it's pretty much business as normal, fortunately. So that takes care of that part of it. So I managed to sell 3 of our properties during COVID-19, actually, from March through August. 2 of them had a delay. 1 actually was no delay at all. It was pretty well sold, minimal time, very minimal work done to it. Georgetown, I had a 3-month delay. About 2 months of that was due to COVID-19, and 1 month was due to foundation issues that we hadn't been known about. The Pflugerville property had a 4-month delay. Again, partially COVID-19. That's when we had problems with the contractors. So the 2 of them combined, if we not had the contractor issue, I probably would have sold it before COVID-19. But again, it's just, you know, there's always more than just one factor on what's going to make a property sell quicker or slower. And that one, unfortunately, had 2 of them. Butte, I managed to sell just like that again. So, but they also less than 90 days on market, and that's from listing to closing time, not just listing to contract time. So fortunately, we were able to make all that happen. But every delay just reduces your profits by so much and everything. So again, those 3 month, 4 month delays, we made profits, but not as much as we would have had it not been primarily for COVID-19. So just part of the cost of doing business is these unexpected things happen. And so now I stay away from Austin until we can get permits going better, and I'll stay away from not buying any more property in San Antonio until that. Because on to the next slide, I do have 2 properties I purchased in January that were, I actually purchased them from a hard money lender he had a investor who bought the properties, and he did all these renovations without city permits. Well, the city of San Antonio they called it a strike force, I believe it was, and they went out and they looked at all these properties being renovated, and they red tagged the properties. Stop doing work immediately. You don't have permits for it. So this investor had already overspent his money on it, and he thought he was going to get away without doing permits. So I recommend, number one, is you always want to get permits. I should say I never, but I rarely ever do not get a permit. So we looked at a very good profit margin in these 2 properties, being the fact that they were, the work was done very nicely. My contractor looked at it before we bought them, and he said, yes, the work looks good. I can probably get it through the inspection process and everything. But then COVID came along, as we were getting ready to just get permits and get rolling. City of San Antonio was like, well, we're working out of home. We can't do anything right now. And so it wasn't until the end of June that we were actually able to get permits back on board. So one, I'm hoping to have it finished by the end of this week, but it looks like it'll be end of next week or middle of the following week. But that one's just about done. And the other one hopefully get done by October. So these delays are they're killing profits. But fortunately, these 2 we got into with a good profit margin. Had it just been a $20,000 profit margin per property, we'd have been being lucky to break even. So again, I'm glad we bought them with that high of a profit margin, because otherwise we'd be looking at. And I'm still looking at properties. I got one I was going to actually look at today, because I thought this was event was tomorrow, so I'm going to go tomorrow instead. So I've got one in Fairfield, Texas, which is kind of triangular midway between Houston, Austin, and Texas, but it's got a nice. They're asking $84,000, and I've got 2 comps that bring it into the 180 range, 180 to 190. It needs a lot of updating, but if I can I'm going to take my contract out. If it's under $40,000, I'm probably going to buy it. The distance doesn't bother me that much, although I prefer to stay closer and everything. But it's a big house. It's kind of like a bedrock community. So again, I need properties. I'm running out of them. Next slide. I think I'm going to be covering, yeah, again, I talk about burning away profits. Again, I said you make your money when you buy, and if you have poor comps or after repair value factors into it and everything, you're probably not going to do very well unless you're lucky. And you need luck in this business, but if you rely on luck, you're not going to, it's not going to be very profitable for you. Contractor issues, I try and always, check out my contractors. I get 2 or 3 that I use consistently, but they're always busy because they're good. So I can't always get them my properties. One thing about contractors, make sure that they do have their own insurance policy and they insure you and your property as they're working on it. So if one of their workers get injured on their property, they don't come after you, they go after the contractor's insurance policy. Title issues and legal issues are typically not very big. I do all my closings through title companies. I'll do contracts at kitchen tables, but I don't buy properties without going through an attorney. So typically there's no issues, but sometimes something just pop up that's just, there's a, the property's in probate and there's some error that pops up at the last minute. Those are things you just can't overcome. So I think I've already talked about permits and inspections in the face, but you gotta best be prepared for delays. Typically there was always delays to begin with, and again with COVID it's pushed out another 45, 60, even 90 days, and that really cuts in your profit. And again, just to reiterate, time will kill it. So when you're looking at a property, for starters, don't try and put a round peg into a square hole. I've had people say, well, that might be an extra $5,000. And I always say, if it's $5,000 going to kill your deal, don't get into it, because you got to expect $5,000, $10,000 down the drain just for anything hidden, and usually it's not going to happen. If it happens, you can't let that put you in the hole, so to speak. And I think that pretty well rounds it up. The last slide here is just a couple of my renovations. Thought I had a bathroom picture in there, but I don't. But this is a staged property I did. And this one is in Taylor, Texas, I believe. We bought it for $120. We sold it for $195, I believe. We did pretty good on it. Excellent craftsmanship. I use these guys as much as I can. They did the Georgetown property for me. But if you'd seen the before pictures, you just wouldn't believe what this property looked like before. Brand new appliance packages. And the staging here, I think it was under $2,000. You can see the furniture and stuff they put in there. It just gives a nice ambiance to the property. So that pretty well sums it up for me. I'll be available for questions when we finish up the presentation.
Thank you, Jack. So again, attendees, I see your questions in the chatting box. So Susie is checking on, and then all the other speakers are also checking on. So don't worry, and we're gonna answer everything either during the session or after the webinar for the Q&A session we're gonna answer. All right, so the next, fourth one, the last one, finally, is my session, the Buying a Home During the COVID-19 Pandemic by me. A little bit bio, I mixed it up, I'm so sorry. So this is me, and I'm a realtor and a member of Austin Board of Realtors, also technical director of Austin KREA. I'm working closely with Susie, okay? So let's begin. So topic, so I don't want to, reiterate everything. Many speakers already, delivered good messages. So I'm going to tell you a little bit of something new as a realtor standpoint. So people are still wanting to buy, that's true, and especially the Austin market. Surprisingly, even open houses, you may be amazed. And then especially since last June is July, now is September, right? And its market is going up. It's very strangely enough, and even under COVID-19 situation. And many people still thinking about either still stay in the lease, or maybe is it better to buy, because of the lender will mention, because the historical low interest rate, maybe it's a good time. But as I said, everybody's different. So we cannot say you have to buy or not. But what I'm saying is, think about all the options on your table and use an expert like Will, talk to him, feel free, and ask all the questions, right? So, and then last thing is a consideration. And then this is a little bit the survey results, and why the buyer, the first home buyer mostly, they trying to buy, especially on the COVID-19 situation. So they still, so as I said, they're still looking for a home, and then they think it's affordable because of low interest rate. And then ironically, they have more time because of pandemic, or they have to sell because of finance issue, they have to downsize, right? And then obviously, or landlord issue, etc. And this is the latest, this is the latest actually, the ABOR statistics, and 2 months old, but still is a good indication here. The key message here, I want you to take it out, is inventory level. It's Austin market is crazy. It's less than 2 months. You know, recommendation is 6.5 months. That is a good balance between buyer and seller. C is less than 2 months. This is strong sellers market still. And then all the index shows increase, low inventory, higher demand, primarily because Austin is very strong in job market, and many big IT tech companies, big guys come in. And next slide. I may be a little bit speed up because I have only 5-6 minutes, but don't worry. If I have a question, I can come back during the Q&A session if you have a question. So lease and buy, this is very important. So if you are doing lease, buy, it's personal decision. But as I mentioned, get all your possible options on your table. Do not limit yourself, and talk to the expert. Will Jackson, talk to David Tucker, talk to Jack, talk to Susie, talk to the professional and get the independent opinion, maximize your potential. So this chart showing, this is a real number actually, okay? It's a Leander, Texas. It's a suburb city and affordable actually. This Austin market is getting appreciated a lot. So people are looking at the suburb area. There's still, you can buy a house at $250K, surprisingly, in California. You cannot believe this, but still, yes, that's possible. Even the brand new home, yeah. And then I helped one of two clients recently. And then if you're paying like $1,600, this is a realistic number, right? Then if you maybe turn around, I'm not qualified. And then don't judge yourself, okay? Ask a pre-qual through Will Jackson first. And he normally provide a free consultation, right? Then you can decide whether you go ahead and purchase or oh, Chris, I want to stay rent. That's fine. I mean, but as I said, don't limit yourself, right? And then it shows with this number, if you're paying $1,600 per monthly, this blue is a purchasing curve. So of course, a lot of upfront costs because of closing costs is a transaction. You have to pay the fees, like a title company, that kind of a lot of fees, right? Inspectors and yeah, of course. But as you see, after 3-4 years, it's a trade-off. So if you're living in your area more than 10 years, the buyer, recently my client told me, Chris, you should tell me and purchase a home 10 years ago. I hope I can get a time machine because after 10 years, you're losing money, right? I mean, if you're living that long time period. So again, assess your maximum potential, okay? And then this is a good slide because if you're a buyer, you have to understand the seller's position. Why the seller trying to sell, right? And then because of retirement issue, family situation, divorce, a lot of job-related issue, job relocation, closer to the job, and or the many family friend issue. They want to live nearby, parents, or that's a traditional region by the surveyed, but this is more up to date. But these are very similar, so I don't want to revisit everything. But there's a lot of like a downsize issue here because of finance issue, of course. And then I don't see any particular thing. Sorry, I have another slide. But anyway, very similar. So still the same motivation, right? Family issue, job issue, yes, still. And downside, retiring, and family situation, etc. And I don't want to talk about a lot because it's more the mortgage company, lender, and then mortgage servicer. But we'll open up really nicely and explain the forbearance plan. I want you to just remember the key topics because some people think that renter hey, Chris, I want to buy a house, but, because of coronavirus, I wonder the mortgage is too burdensome. Like, I don't, if what happened, okay, do I have any option? Yes, this is an option. If a temporal relief remedy, so gracefully everybody's different, lender's different, okay, so I cannot say anything, but remember the key topics here, okay, forbearance plan, repayment plan, deferral, loan modification, etc. So talk to the experts, okay, before you find a decision. And then homeowner. So if you're a buyer, you turn around a homeowner, what is the benefit? A lot of benefits, right? But you'll think about, Chris, I don't know, maybe 10 years I may want to sell. Yes, of course. Everybody, in the same situation. But if you're a homeowner now, and then you will have to sell, or you're thinking of, you may need to question yourself, whether I have to sell fast, or can you wait? Are you flexible? Did you find your next home? Or you have a sufficient equity? If you pay all the mortgage out, do you have any remaining balances? And do you want to just top dollar out of it using your hiring the realtor, or just sell it as quickly as possible using the iBuyer? Or do you need to move out as quickly as possible? But what's your current situation? Continue upon sell your current property in order to move out, right? But the one key takeaway from this slide is EasyKnock is a niche solution. If your situation is too complex, don't worry, this is your solution. Remember this, and then you can contact me. I can provide all the information. You can sell your property and stay at your current property as a renter. They allow it. Okay, so that's your solution. And then also you can buy back within a time range. Of course, everybody's different, so I cannot generalize, but they have an option. So if you have a temporal finance issue, you may consider that as well. So consideration, once again, oh yeah, this is it. So many people trying to buy because of home office, remote working issue. So if I fall into this category, yes, think about it. And then check all your possible loan options. Will Jackson here, you stand by, answer all your questions, provide a free consultation, provide free coffee if necessary, right? Will. And low interest rate benefits, of course, and compare a benefit, lease and buy. I can help you with that. Okay, real number. Okay, don't worry, and free consultation as well. And then understanding homeowner position. Okay, so any question, let me know. That this is my contact information. I think its time is almost ready. Okay, so it's a Q&A session. I think people are typing in. Susie, did you get some questions for the speakers? I think one question, lender question, right?
We could ask the question to Jack. Do you have any advice for buyer who want to buy renovated houses? Jack, would you be able to answer?
Okay, as far as for buyers who want to buy a renovated house, I typically just list them through a realtor. So probably the first thing for any buyer buying any house, not just renovated houses, they would want to get a home inspection. You want that. When I get first-time buyers with my properties, depending on my profit margin, I'm very generous with closing help, things of that nature. I use realtors 9 times out of 10 in selling my properties because, again, you get the better spread for, I'm going to get to the population instead of just a few people. But as far as for a home buyer, really the loan officer is a key to getting them into the home.
Okay, I think
I would like to ask each speaker during this pandemic era, where we are in this situation, in your area, what would you give one thing to take away for people who join this webinar?
So Susie, before that, actually someone asked a question to Will Jackson. Do you think it's better, Will, to answer that question first?
I didn't see it. Yeah, go ahead, please do.
Will, did you get the question in the chatting box?
Yeah, it was actually a private message about home equity lines of credit and down payment requirements. And basically, I answered the questions, but basically there are some options available for home equity lines of credit currently. Most of the time those go through banks, for the home equity lines of credit versus a non-bank lender like myself. Although I can send them to non-bank lenders, like broker them, or to, sorry, a credit union, I misspoke. And then the other question was about down payment. And that was whether 5 or 10% was really necessary now. And basically the answer is that down payment requirements did pull back for a couple of months when the pandemic started, but 5% down for a conforming loan now is back to being fine. And, you know, really the main impact of 5 versus 10% down has to do with what the mortgage insurance premium per month is. So it's, you know, it's significantly higher on 5% down than 10. So, you know, that would really be the main difference in those two down payment amounts.
And I see another question to David. Someone, I don't think David answered during the session, is he said you told there are more activities even during in COVID-19. Can you elaborate what kind of things are the most active in this pandemic? David, did you get the question?
I did not, but if you can repeat it, I'll try to answer it.
Yeah, can go ahead.
So something about COVID-19. I'm sorry, Chris, the question again, please.
Yeah, the
Repeat the
question is, yeah, Susie, go ahead.
I cannot because my computer got
Oh yeah, don't
kicked
worry.
out of.
Okay, let me
I
repeat the
cannot read.
question. So someone asked David that you told that there are more activities even during on COVID-19. Can you elaborate what kind of things are the most active in this pandemic?
Okay, so you know, what I'll say to that is, you know, we were doing 2019 tax returns, so we saw a lot of VRBO and Airbnb activity. For 2020, it's definitely been a slowdown. But the things affecting taxes for the calendar year 2020 have been things like the PPP loans, the stimulus payments of $1,200, people filing for unemployment. And we've seen a whole host of new residential activity out there too. People are buying homes. A number of people are buying a second home so they can work out of. And I think next tax year when we're doing 2020 tax returns, we're going to see a lot of activity because of COVID for those reasons.
Thank you, David. I think I answered the current active questions. But Susie, do you ask all those?
Yeah. I want to ask each speaker if you can say one thing to share with us about your area that we can take away, something good, something negative, or something to look for so that they understand what is going on. From Chris?
Oh, yeah. Okay, let me start. So, yeah, revisit what I emphasize, don't limit yourself. Surprisingly, many buyers, they think that even if you're being rejected by a local bank, the big bank like Bank of America, let's say, you know, it doesn't mean that you have no option. Because sometimes the other mortgage lender will, you can elaborate later, but sometimes surprisingly, they have other options. The reason why is some lender, they have additional options. He mentioned non-QM as well for the business owner, self-employed. Some traditional bank does not have the option. And then many people misunderstood that, oh, Chris, I want to compare all the options, but okay, I don't want to pay upfront. There's no upfront key normally, okay? So you can ask the question, okay? You can get free consultation with the lender first over the phone or something, and then get the approval letter. Then you can, you know, I don't know, I want to stay on the rent. That's fine too. Will, do you want to accommodate a little bit? Oh, you're on mute. Okay.
Sorry, I was unmuting.
Yeah.
Yeah, there are definitely a lot of options that traditional banks don't have to get people approved, whether it comes from non-QM like you're talking about, or even things like if somebody's been self-employed for 5 years, we can typically use 1 year of tax returns, and that's a Freddie Mac requirement. And I end up, or Freddie Mac allows for that, I should say. And, you know, I see deals in situations like that where a bank has an overlay where they don't allow that, but, you know, we just underwrite to the direct guidelines. And so we're able to do that. I mean, since I'm kind of speaking, I guess I'll kind of throw a couple of other things out there real quick. One is that we're in unusual times. And so, you know, when people are getting loans, sometimes they're like, well, the last time I got a loan, I didn't have to do that or provide that. Just be aware there might be stuff that you have to supply that you're not used to supplying when you get a loan, and, you know, try to be a little patient with that. And then, you know, Chris might be able to speak better to this than me, but we do see a lot of multiple offer situations where, you know, somebody makes an offer but doesn't get the house. And, you know, it might take 4 or 6 times of making offers before they actually end up winning the house, because there's not a lot of inventory right now in Austin.
Correct. Appreciate it. So Jack, do you have any key message?
I guess what, you know, we're talking a lot about houses and things and everything, but we're really in the people business. So I strive to try and make it a win-win all the way around. You can't always do that, but, you know, you're working with people, whether you're buying a house from somebody, you're working with contractors, working with lenders, accountants, realtors, guys like me. So keep in mind, you know, you're affecting somebody's life, hopefully in a very positive way, and just strive to make it a win-win all the way around.
Chris, can you elaborate one of the questions?
Yes, I saw that.
About
yeah.
that?
So let me repeat it. Someone asking me confused about concept of sell and stay. Yeah, this is a new concept with the easy knock. Is not everybody. That's only the company that I found so far. And recently, I you get educated with these guys and find they're working with the realtor. So think about the iBuyer like Open Door. You can sell your property completely. So instead of an individual buyer, there's a company buyer, right? So they're easy to understand. But this is like a kind of between. They access your equity. So not complete transaction. Of course, their agreement, okay? That's a business deal. But they access to 80% of your equity, 20% is remaining for the option. So they giving you an option. It's really hard to explain everything. It's really complex. But as I said, they have a website. If you want, I don't have your contact information, but if you type it out, you can privately send me your email. I can send you over my contact information. I can reach out to you and send you the link. And yeah, it takes time a little bit, but as I said, they done in the business for a while. Oh, great. Yeah, you can email me. Okay, thank you. Susie, do you, anybody attendees, they have any question? Do we have a time? Let me see.
Yeah, yeah, we still do have time. Yeah, we still have a few minutes.
So if our speakers are available for 1 or 2, 3 minutes, then we can stand by, answer your question again. But just someone who are busy, I show you a screen now is all the contact information, basically the email address, and Susie and David and Jag, Will, and myself. So feel free to reach out and email us, and we will respond. And again, you can feel free to type it out here in chatting box.
I want to thank you for everybody who's in this list. They have at least so many years of experiences in the area, and they are expert in the area. So write down or take a photo of this screenshot and ask them any questions that you have, and they will answer you whatever you have, even privately.
Great, great, great. All right, I think I don't see any further questions. So any speakers, any last comment, whatever you missed something? Oh, Chris, I missed something. Okay, over. Susie, you want to wrap it up soon, maybe? Or maybe while we're waiting, I don't see any upcoming questions. So we are sharing
Chris,
all the
you can
contact
wrap up.
information here. Yeah.
I want to
Susie?
thank you, all of you who joined our webinar, also our wonderful speakers, and you guys are wonderful, and thank you so much. I do appreciate you.
Thank you so
Thank you
much.
for,
Most welcome.
thank you for including me.
Glad to participate.
Bye.
Thank you. Thank you,
Thank you.
everybody.
Thank you. Thank you.
Right on.
Thank you, everybody. Okay.
Bye, Jack. Thank you so much. Thank
Bye.
you. Thank you, Chris.
Bye, Susie.